All right. Well, I do once again, I appreciate you all in your ability to pivot to this online modality for today, given the weather situation that we've encountered. So I really do appreciate that. Appreciate your flexibility and the opportunity to join me today. So. As I'd mentioned earlier, as we go through today's lecture, please feel free to unmute your microphone and ask your question. You could use whatever, or you could type it in the chat or whatever you're comfortable with. And, let's make this as interactive as we can. I know it's a challenge when we're online, but we're going to have some fun today because I really love the two chapters that we're going to talk about today. We're going to talk about how we account for retailers and how we account for inventory. And so, you know me, I'm going to use one of my favorite retailers in our examples, good old Macy's. Macy's coming back. All right. So, okay. So let's go ahead and get started. I know y'all love the Macy's, right? Let's go ahead and get started and have some fun with this. I have a feeling you're going to really enjoy this conversation. So, let me go ahead and start by bringing up the first presentation. So, for those of you who are following along at home, we're in week 3 already, if you can believe that or not. We're going to cover 2 chapters today. We're going to cover chapters 5 and 6. You can find those chapters presentations within the instructional materials. Both of them, chapter 5 and chapter 6, are there. Also, just like we have in every week, some Excel exercises and some Firebirds Cookie Company exercises. And for this week, we have just 2 assignments for you. One's a chapter 5 quiz, the other's a chapter 6 quiz. So without further ado, let's go ahead and jump into chapter 5, which, as I'd mentioned before, one of my absolute favorite chapters, and that is accounting for merchandise operations. I really like this one because, I think I mentioned this in class. Uh, I spent a lot of time working in retail, and I think you all know that. I started my career in the grocery store business, which is technically retail, selling groceries, right? Uh, and then moving over to Sears, selling vacuum cleaners. I'm sure I talked to you about that. About the commissions, remember? So, yeah, so I have a lot of experience in the retail space. And outside of that, of course, I did a little bit of management, assistant management work with Starbucks. Technically more of a service type business, but still technically retail. Um, and all of those experiences have really taught me a lot about how we in business look at these retail operations and analyze their overall performance. Now, some of you might be like me and you're interested in investing in some of your favorite brands, maybe in your retirement portfolio, or maybe you got some single stock that you like to purchase, or, that type of investing, which is great. But, you really need to know the business. And if it's a retail business, I think that this chapter is going to be real interesting for you. So let's go ahead and jump in and talk about how we account for retail businesses. So I'm going to show you a bunch of transactions that are recorded in a retail business. When a retailer purchases inventory, when they sell inventory, uh, and how we go through the rest of the accounting cycle by making our adjusting entries and closing our temporary accounts. And I'll also show you how the income statement is impacted by all of the journal entries that are made in a retail business. So the way I want you to really think about how we record our transactions is I want you to think about how the business works. What's involved in the business. Think about the physical flow of the business. And that helps me to understand things too, right? It's like, oh, I found this pair of sneakers over at Macy's. I brought the pair of sneakers to the counter. The cashier scanned the barcode from the tag of this pair of sneakers and the tag on the box. Um, they said, "Oh, it would be $100." I paid them the $100, and I took the inventory, their merchandise home. So there was a couple of things that happened in that flow, in that physical flow of the merchandise. I took it off the shelf. I brought it to the cashier. They scanned it. As soon as that barcode is scanned by the reader, it takes it out of their inventory. Okay. So they use what we call a perpetual inventory system. I'm going to be talking about that a lot today. And, they scan the barcode, takes it out of their inventory. It updates their inventory accordingly. Tells you how many of that item is left on the shelf. And then when they make the sale, meaning I pay for the $100 for the sneakers, their cash register system makes an automatic journal entry. They debit cash, credit sales, $100. And then there's a second transaction because they have to recognize the sale of that inventory. The inventory only cost Macy's maybe $20 for the pair of sneakers. So they're going to debit cost of goods sold $20 and credit inventory $20. It's really a two-step process, two transactions related to one event. And that is the physical flow of inventory. When a retailer sells inventory, that's what happens, right? So I want you to kind of get in that mindset of, what it's like when you go to the store and you take something off the shelf and then you pay for it. Well, what's happening on the back end? That's what I want you to think about. So, before we jump into retailing, I just wanted to quickly show you the difference between a retailer and a service business. So, in a service business, they don't have inventory. Like a dentist, they don't have inventory. They're not selling products. A lawyer, they don't have inventory. They're not selling products. An accountant, they don't have inventory. They're not selling products. A plumber, again, no inventory. They're selling service, right? Um, electrician, you name it, right? These are all service businesses. They provide a service. They don't carry inventory in their business. So they don't have a cost of goods sold. So for a service company, their income statement is going to have sales on the top, just like it always is. And then they'll have all their expenses listed out. And at the very bottom, they'll have net income. And the way that they calculate their net income is they take their sales or revenue minus all of their expenses equals net income. Pretty straightforward. Service companies are very easy to operate. Then we get into a retailing business, also known as a merchandiser. I call them retailers because that's what you and I know them as. A retailer sells products, they sell inventory. A retailer like Macy's purchases their inventory from their distributors. The reason why they're called distributors is because they distribute product or merchandise that they purchased from the manufacturers. Okay. Think of a distributor like a middleman between the manufacturer and the retailer. So think about Macy's. Okay. Macy's purchases their inventory from the distributors. The distributors purchase their inventory from the manufacturers. Okay. Did I talk about the markup on clothing with this class before? Do y'all remember? Maybe I'm dreaming it. Did we ever talk about that?
I
Repeat the
don't
question, I'm
remember,
sorry.
Professor, but I like to hear about it.
Oh, we're gonna love that then. Okay.
Okay, yeah, go right on.
Okay. I don't know. Y'all might feel certain kind of way after I tell you about how these retailers actually work. Okay.
That so if Macy's
We
buys
need the
something for
insight.
75 cents, then they sell it for $1. Is that what you're talking about?
Yes. Do you remember that?
How?
Okay.
Did we
Yeah,
talk
we
about
need
Yes,
that?
the
that was the
insight.
first class.
Okay.
Yeah, we talked about that.
I figured we did.
Mhm.
I just couldn't remember. All right, but let me just kind of recap for those of you who may have missed that discussion. So the way retail works is that they sell their inventory, right? Their merchandise, their product. So you go to Macy's and you find this lovely shirt, t-shirt that you like. It's $50 is the retail price, and Macy's don't pay no $50 for that retail, right? They're for that merchandise. They don't pay that. You're paying that. You're the customer. Okay. Macy's bought that same shirt from their distributor for about 75 cents, maybe a dollar. And the distributor bought that uh, t-shirt from the manufacturer for about 25 cents. Now, I'm not making these numbers up. These are real numbers. That's the markup of clothing. Clothing, it has one of the highest markups out of any product you'll ever purchase. That's why if you ever go to a store like Macy's, and you go back to that discount rack. Oh, Dr. B loves a good discount. You know I do. I'm all about that clearance. Okay, that's me. Yes, love me some clearance. So I go back to the clearance rack, and I say, "Oh, that's a lovely shirt. It says the MSRP, manufacturer suggested retail price, says $50. They have it on clearance for $5." And you think to yourself, wow, there's no way Macy's is making a profit. It's impossible. How can they make a profit selling it for $5? You know, 90% off of the clearance rack. You think to yourself, amazing. There's no way they're making a profit. Oh, you are sorely mistaken. I promise you they're still making a profit. In fact, they're making a $4 profit on that sale, right? So the next time you go into a retailer and you go to that back shelf over the clearance rack, you better believe they're still making profit. Okay. So that's clothing has some of the highest markup out of any product sold. The next one that I think has some of the highest markup percentage is furniture. Oh, darn. Oh, furniture. Let me tell you something about furniture. Oh, Ashley furniture. Oh my goodness. Good, great quality stuff. Don't get me wrong. I think the furniture is some of the highest quality. It depends. Depends on the type of furniture and it depends on what you're getting and where you're getting it from. There's big differences in furniture manufacturers. But I can tell you that, certain manufacturers like Ashley Furniture or retailers like Ashley Furniture or Bob's Discount Furniture, which was one of my favorites, um, or you know, you name it, right? These furniture retailers, they work pretty good deals out with the manufacturers and the distributors. So let me explain to you how this works. So you go to Bob's Discount Furniture and you go find yourself a nice, let's say you're looking at a new bedroom set, okay, a whole set, the two nightstands, the bed frame, the thing that goes in the tall thing that goes in the back, maybe big dresser with a mirror, okay, whole set. Bob's Discount be selling that for, let's say, $1,000, okay, for the whole set. Wow, you think to yourself, that's an amazing deal, you know. And you go to the furniture store, you start testing it out. Oh, this is good quality, and it is good quality, definitely is. I'm not knocking the quality. Believe me, I think the quality there is very very good. And $1,000 is a good price for all of that furniture. Because if you found the same set over at Ashley Furniture, I guarantee you'd be paying a lot more. So what most people don't know is that Bob's Furniture and Ashley Furniture get a lot of their stuff from the same place. Okay. So they're,
Mr. Schwartz.
yes, say it.
So, question. So, even though that we talking about merchandise and stuff like that, but ain't this still important because employees and stuff like that? Because when you get employees, get some of the employees from these other countries, and they
Yeah.
pay them less money for the
Yep.
call center, and they pay them way less.
You got it. That's it. That's how they're able to sell this furniture and make huge profits because the manufacturers are typically located in countries that are, uh, how do I put this nicely? Uh,
China and stuff
they pay their people very, very little.
like $5, and they like so like
Oh,
say
that's
the
even that's
minimum wage over
high.
here is probably like $18, but they paying them like $5 for
$5
work.
for the manager. I think, the people on the front line make about anywhere between 50 cents an hour up to $1 an hour. So, so I'll give you the example of the furniture. So, there's a couple of countries that do really great work when it comes to making furniture. One is Vietnam. They make amazing furniture in Vietnam. India makes pretty good furniture as well. And then we have China. So, out of the three countries, the best manufacturers in Vietnam. The second best quality is going to be from India. Third best will be from China. Now, I want you to think about what Danita just brought up, which is a very interesting part of this discussion. So the reason why they're able to keep their costs so low for making furniture is one of the largest costs in any business in the world, any business. I don't care if it's mom and pop all the way up to Fortune 500. The most expensive cost of any business is labor. Okay. Uh, in Vietnam, the average hourly rate for a manufacturer of furniture is about 30 to 50 cents an hour in US dollars. Now, to you, that sounds like, how can that be? Because it's so little, right? Well, you have to understand the economics of these other countries. In Vietnam, somebody making 50 cents an hour is actually doing pretty well for themselves because the cost of things are very low. Rent might cost something like $100 a month. Okay. Electricity might be $1, $2 a month. Food might be, 50 cents a meal. So you have to put it in context of where the furniture is being made to understand why people are paid so little in these countries because things cost a lot less in those countries as well. Okay. So, the cost of making the $1,000 set, the bedroom set that we are talking about, to manufacture an entire bedroom set might cost maybe $5. I'd say maybe 10, and that might be stretching because it's higher quality. Maybe $10 to make the whole set. Okay, that includes labor, direct materials, and factory overhead. Okay, all in $10 for the whole set of furniture. Manufacturer sells that to the distributor for about 15, $20. Distributor sells it to Bob's Discount for, let's say, $50. Okay. They turn around and sell to you for 1,000. But you also have to consider there's other costs that go into this. This isn't just $1,000. Oh man, Bob's killing me over here. No, what cost? They have to pay their employees. They have to a lot of overhead. So in reality, Bob's paying more than $50. They're just paying 50 for the material or for the inventory. So it just kind of puts things into context for you. So clothing markups about 1,000%. For furniture, it's anywhere between 700 and 900%. Those are the two largest things in the world where the highest markup percentages are clothing and furniture. And then electronics might be third or fourth place. And then there's a couple of other ones, but the percentage goes way down after that. So just want to put it into context for you. So for a merchandiser, a retailer, on a retailer's income statement, they have their sales, just like we have sales for a service company. The difference between the service company and the retailer is that we also have this thing called cost of goods sold. This is the total cost of the inventory that was sold. That's why I call it cost of goods sold. It's the cost of the inventory that we sold. Cost of goods sold. Okay. So we take our sales minus our cost of goods sold to get what we call gross profit. The reason why we call it gross profit is because this would technically be the profit before all of our expenses. Gross profit. And then we have all of our expenses, just like we do in the service business. And then we also have our net income, just like we do in the service business. So to calculate the income statement for a retailer, we take our sales minus our cost of goods sold. We take our retailer minus our cost of goods sold. We take our sales minus our cost of goods sold equals gross profit minus all of our expenses equals net income. And that, my friends, is the primary difference between a service company and a retail company. Now, of course, there are some other differences as well, like the operating cycle for a retailer is different than it is for a service company. So, as you know, when we sell our inventory, our customers can pay us in one of two ways. The most common way is cash over the counter. Yeah, definitely. You know, like Macy's, for example. The majority of their customers are cash paying customers. We also consider credit cards that customers use as cash. It's the same, works the same concept. Credit card, debit card, and cash, we treat them all the same way. They're all cash to the business. Okay. So customers will pay in cash, credit, or debit. The business treats all three of those methods of payment as cash because the business is receiving it right away. The other way that customers might pay us is through accounts receivable. We might work a deal with a customer where we say, hey, customer, you know what? You could pay me 30 days from now, I'm going to sell to you on account, right? Or on credit. So what that means is that we're allowing the customer to pay us 30 days later. Either way, the customer is going to pay us. It's just a matter of when. Okay. It's important to remember that part because the business needs cash in order to purchase our inventory. We need cash and oftentimes we need credit. So just like the business might allow the customer to pay 30 days later, the business should also work out a deal with their vendors to pay them 30 days later as well. Okay? So the business will either use cash or credit, which is accounts payable, with their supplier to purchase inventory. The business receives the inventory and proceeds to sell the inventory. Customers will purchase the inventory either using cash or on accounts receivable. And then the business collects the accounts receivable, and then the cycle starts all over again. So as inventory goes down, we purchase more, right? Because we always want to make sure we have enough inventory on hand to sell to our customers. We call this the operating cycle for retailers. I'm sorry.
Mr. Sword, I have another question.
Anita, please.
Even though that business sell items and they make up a profit from it,
Sure.
but what happens like when a business? How do they make a profit from when like a nonprofit or federal agent come into there and a tax exemption and they don't have to pay for the taxes?
Right. No, great question. So typically their overall profit will be slightly less in that case. So let's say as you said, let's say you have
So
a
how you balance that out?
I'm sorry.
So how would that be balanced out on the balance sheet or something or the cash flow?
Yeah, all we do is we take the total sale amount is what's reduced. That's the only difference. That's the only difference. That's where we would take out because of that status. That's the only difference. Is that the actual revenue that we take in will be slightly less. That's it. So the effect would be on the income statement for sales, and it would be probably on the cash amount because it'll be slightly lower. But that's the only difference. Yeah, good question. So, uh, I'd mentioned earlier, it's good to think about the physical flow of how the business works because we have to be able to understand how to treat the inventory in the business. The inventory is the merchandise that the business sells, as you know. And so we got to figure out how much inventory is available for sale. That's a great question. We got to know what's the value of the inventory that we have that's available for sale. We can do this really of one of two ways. One is that we can take our net purchases, all the inventory that we purchased, plus our beginning inventory balance. And that'll tell me how much inventory is available for sale. The other way of looking at this is that we could take our cost of goods sold and add that to our ending inventory, and that'll also tell us what the inventory we have available for sale is. So really do this either one of two ways. And so we take our purchases plus our inventory equals available for sale. And then when we sell it, it becomes cost of goods sold and it gives us our ending inventory balance. All right. So retailers have one or of these types of systems to track their inventory. Okay. The majority of large retailers like your Macy's or any other larger retailer, your Macy's, your Nordstroms, your whoever's, they use what we call the perpetual inventory system. Just as the name implies, perpetual means continuous, right? In perpetuity, that means continuous. Yeah? It's always going to be updating, perpetual. So, the way that this works is that the barcode system, as I'd mentioned, I took the pair of sneakers off the shelf. I brought it to the counter. The cashier scanned the barcode. As soon as the barcode scan, it takes it out of their inventory. It updates their records automatically. Okay. They're using what we call the perpetual inventory system. So it updates all of their sales, all of their purchases as it happens in real time. Okay. Uh, and that works great for companies that sell a lot of different types of products. The other type of system that a company might use is called the periodic inventory system. And this is where the business updates the sales periodically, you typically at the end of the accounting period, end of the month. Okay. Now, the type of business that might use the periodic inventory system would be businesses that sell once in a while. They sell very unique items. They would use periodic inventory system. For example, a car dealership would use periodic inventory system. There's no barcode on the car. Okay. So they do physical count. They update periodically. There's a lot of sirens outside today. Oh, what's going on? Anyway, so that's the difference between the two. All right. Now, what I'm going to show you next is the difference between the perpetual and periodic inventory systems. And I'm going to really show you from the perpetual side because that's what we care about, at least in this class. Because it's a little bit more complex. And so I really want you to understand how the perpetual inventory system works. And I'm going to walk you through some very simple examples to help us to understand the concept. So here we have the corner store. Oh, I love the corner store. They sell snacks. They might even sell gasoline. Oh, I love the corner store. Okay. So here we have the corner store. Corner store, November 2, corner store purchased $500 worth of inventory from their vendor. Okay. This is a local business, very, very local. It's that shop, that little bodega on the corner that you love to visit. Yeah. It's the one right there by the house, a couple blocks down. You walk down, you get yourself candy bar and the snack, and you walk back. That's the kind of business I'm talking about here. Very small, very local. So local mom and pop type of shop. So here we have November 2, our local corner store purchased $500 worth of inventory from their vendor, and they just simply paid it in cash. Yeah, no problem. Vendor comes in, here's your inventory. The owner pays them right then and there. Boom. Write the check. Boom. Simple. Okay. So we debit inventory to increase our inventory. As you recall, inventory is a asset account. And then we decrease our cash by $500, also an asset account. Now, what I always tell small business owners when I consult with them, especially the corner store, is I say, hey, listen, you should really establish credit terms with your vendors So that way you can pay them 30 days later or 45 days later, or whatever the credit terms are. So this way, what this does is it allows the business to hang on to their cash a little bit longer before they have to pay the bill instead of paying in cash up front. Why this is good? Because you might use that 500 bucks for some other reason in the next 30 days. Okay? You want to have a good amount of cash on hand at all times in business. Very, very important. Okay? I cannot tell you how many times I've seen retailers go out of business because they've never had enough cash on hand. One of my favorite examples of this. Do y'all remember this company called Bed Bath and Beyond? Have you heard of that store before?
Yes.
Yes, yes, Bed Bath and Beyond. If you've never been inside a Bed Bath and Beyond store, here's how it used to look. You would go in and they would have their inventory stacked to the ceiling along every wall. Every time I'll go in there, I would say, "There's no freaking way this company's going to survive." This was a long time ago. I knew that we weren't doing well because I'll go in and I'd see all this inventory in every single one of their stores. And the first thing that comes to my mind when I see a lot of inventory is they don't have a lot of cash. Why? Because it's all tied up in inventory. Right? So it's important that if you go into business and you're going to be selling product, I don't care what it is, all right? I want you to try to establish credit terms with your vendors because it's important that you have enough cash on hand in order to operate into the future, right? Cash is king in business. So that's why it's first on the balance sheet. It's king. That cash is how the world works, and that's how business works. So establish credit terms with your vendors. Now, the way credit terms works is that you negotiate with your vendor. You say, "Hey, listen, I'm going to establish a credit period. This is the amount of time that I need before I can pay you back." All right. Now, sometimes your vendor might be really cool and they'll say, "Hey, listen, if you pay me within the first few days of this bill, I'll give you a discount." Right? No, that's nice. Okay. Yeah. That's incentive to pay them early. And there's a discount involved. So, and it's throughout a specific amount of time. The discount period might be like 10 days or whatever. And the whole bill is 30 days. So let me show you what the credit term looks like. This is the credit term. And it's going to be written like this. And the way to say this is like this. 210 net 30. 210 net 30. Here's what it means. You've received the bill from your vendor. And the vendor said, "If you pay me within the first 10 days, I'll give you a 2% discount on the total. Otherwise," that's where the comma comes into play, "the whole thing, letter N, is due within 30 days. Okay? So, I'll say it again. 210 net 30 means if you pay within the first 10 days, you receive a 2% discount on the total amount. Otherwise, the entire thing is due within 30 days. That's what it means. That's the credit term. And this can be written all kinds of ways. It doesn't always have to be 2%. It doesn't always have to be 10 days. It doesn't always have to be 30 days. It depends on what you negotiate with the vendor. It could be 5% if you pay within the first 15 days. Otherwise, all things due within 45 days or whatever. But the terms are always specified and it's always written like this. So you get your bill in the mail from the vendor. All right, so the corner store got their bill. It looks like this. We call it an invoice, same thing. It's a bill from the vendor. And it has a couple details: who the vendor is, the date of the bill or the invoice. Very important to know the date. Uh, who the customer is, the date of the purchase order. That's when the store, ordered the inventory. Yeah. It was delivered to us on 11/2. We put the order in on 10/30. So 3 days later, they brought the inventory. This bill has credit terms of 210 net 30, which means 2% discount if we pay it within the first 10 days. Otherwise, the whole thing is due within 30 days. And then it has shipping details. In this example, it says the shipping details are free onboard destination. Free onboard destination. What that means is that the seller is responsible for holding that inventory until the inventory reaches its final destination. Okay, so the seller is responsible for the inventory until it reaches its destination. We call that free onboard destination. And then, of course, there's going to be a list of exactly what's in there, the quantity times the price, give you a subtotal, and then if we're paying shipping, that'll be on there plus the tax, and give us a total. Then it might also tell you what we would pay if we were to take the discount by paying in the first 10 days. So those are all the details on the invoice. So you being the savvy business person that you are, you know that we need to make our journal entries. So the first journal entry we need to make is the receipt of the inventory. We received the inventory on November the 2nd. So I debit merchandise inventory $500 and I credit accounts payable $500. Why 500? Because that's the amount that was on the invoice. That's the total amount. And then we put in the notes, hey, terms 210.30. Now, this could go one of two ways. We could either pay within the first 10 days and receive the discount, or we could pay the whole thing, right? So let's say, hey, yeah, we're going to pay in the first 10 days. I want to take advantage of that discount. So I'm going to debit the account payable for the $500, and then I'm going to credit cash $490. Why $490? Because it's 2% discount of 500. So 500 times 98% is 490. The difference is $10. The difference we credit to an account we credit that directly to the value of the inventory. Why? Because the value of the inventory is now all of a sudden $10 less, because I'm paying less for the inventory, right? That's why we credit the inventory by the $10. This is what it looks like on your T accounts. So as we can see, the payable came in on November 2. It went out on November 12. Inventory came in November 2. We reduced the inventory by $10 November 12 to reflect the discounted amount. And our cash went down November the 12th by $490. Otherwise, if we don't take advantage of the paying in the first 10 days, the whole thing is due if we don't take advantage of it. So we just simply debit the account payable 500 and credit cash 500. Now, I love taking discounts. It's really important in business because, you don't want to pay the whole thing. I want that cash. Remember, cash is king. All right. This next part I need to talk about, and I'm never too happy with returns and allowances because number one, I don't like to return stuff. It's a pain in the butt. When I have to do it, it's a pain in the butt for the business because they have to return inventory when it's defective or whatever. And people don't like having to do it either, right? So there's two possibilities of what happens when the business receives defective inventory. One is that the distributor or the vendor could say, hey, listen, why don't you keep that junk that we sent you? And what we'll do is we're going to give you a discount or a price reduction on that inventory. Cool. We call that a purchase allowance. The other possibility would be that we're just going to return the inventory. We call that purchase return. I'm going to walk you through an example of each. So remember, we received that inventory on November 2nd. $500 of inventory, we received it November 2nd. So we open up the box and we go, hey, listen, man, some of the stuff is broken. I can't sell this. So we call up our distributor and we say, hey, listen, some of that stuff you sold me is broken. And we estimate about $30 of this $500 of inventory. We can't sell that. So the vendor will say, okay, no problem. We're going to give you a discount for that defective inventory. Don't worry about returning it. Okay, no. So we're going to debit the account payable $30 to reduce the bill by $30. And also we're going to reduce the inventory by $30 because we can't sell it. It's defective. Yep. So that's the type of transaction we would make for an allowance. Now let me give you an example of the dreaded returns. So here we have an example for June. Our corner store purchased $250 worth of merchandise on June 1st with credit terms of 2% discount if paid within the first 10 days. Otherwise, the whole thing's due within 60 days. We open up the box on June 3rd and we say, hey, listen, some of the stuff, we can't sell it. So we call up the vendor and we say, hey, we're going to send you back about $50 worth of inventory because we can't sell it. So they agree. And so we have to record that return. And the way we do that is we're going to debit the account payable and credit the inventory because we no longer have the inventory, we're sending it back. Which ultimately means that we've reduced the entire account payable by that $50. So on June 11, we're going to pay. We're gonna pay them, the company. But as you can see, we're paying within that first 10 days. So we're going to receive a 2% discount. That 2% discount doesn't apply to the 250. It applies to the 200 because we sent back $50 of inventory. We no longer have that. So the remaining balance, 200, we're going to take a 2% discount from that. So 200 times 98% is $196. So a debit account's payable 200, credit cash 196, and I'm going to credit our inventory by $4 because really the value of the inventory is $4 less because we took a $4 discount. That's how that works. Earlier, you heard me mention free on board shipping point. Understanding the shipping terms is really important because it tells you who's responsible for the shipping, who's responsible for the inventory while it's in transit. Okay. So there's two possibilities for shipping terms. One is called free on board shipping point, which tells me that the buyer uh, is responsible for the inventory while it's in transit. And then there's free on board destination, which means the seller is responsible for the inventory while it's in transit. Now, from our corner store experience, we had our free on board destination that was on that invoice I showed you earlier. That means the distributor was responsible for the inventory while it was in transit. And so the seller had to pay for shipping. There are cases where the buyer has to pay for shipping. We call that free on board shipping point. So on the buyer, whoever's buying the inventory, they have to pay for shipping. And so we add that shipping cost to the total cost of the inventory. So we debit merchandise inventory and we credit the cash to pay for the shipping expense. If the seller is paying for the shipping, we just simply debit the delivery expense and credit cash. If that's the case. So that's the difference between those two. So when it comes to making the journal entry, it's very simple. Our corner store purchased inventory free on board shipping point, meaning that we had to pay for the cost of shipping. So we're just going to add that cost of shipping to the total cost of the inventory. Debit the inventory, $75, credit cash $75. For a retailer, we look at the total cost of our inventory as what we call landed cost. Let me explain this process. The purchase price is typically not the total cost. There's the purchase price plus insurance for shipping it to you, plus maybe the taxes, plus the shipping cost, right? We call all those landed costs. It's whatever the cost it is to get the inventory landed in your store. Landed cost. It's the purchase price plus the tax, plus the insurance, plus the shipping. All those costs together equals the total cost of the inventory. And there might be some minuses of that total cost. The minuses would be things like if we got a discount on the inventory when we paid for it, or if there were some returns and allowances. So here we have an example for the year for our corner store. We had a total cost of inventory of $235,800 plus cost of getting it to us, $2,300, minus any discounts and minus any returns and allowances for a total cost of the inventory of $232,400. That's how we determine the value of the inventory. Okay. That's how it works. That's how retail works. Now, using the perpetual inventory system, it's pretty simple, because we're just scanning the barcode, takes it out of inventory. Everything updates automatically for us. Very, very nice. I love the perpetual inventory system. And those are the things that we learned about in our examples with the corner store. Yeah, nice and easy. Now, when we look at the income statement for the retailer, the top part looked like this. We had our sales minus cost of goods sold. Remember, cost of goods sold is the cost of the inventory. that we sold. So sales minus cost of goods sold equals gross profit. Gross profit is a computation that represents the profit that would have been earned before any expenses are paid out. So sales minus cost of goods sold equals gross profit. Then we subtract out all of our expenses to derive net income. When we sell inventory, there's really two things that are going on. Okay. First thing that's happening is we're receiving revenue from the sale, right? So we debit cash or accounts receivable and we credit sales, right? So we record the sale. The second piece that we record is the sale of the inventory. So because obviously we need to reduce our inventory. So we debit cost of goods sold because we sold the inventory and we credit inventory. That occurs for every single transaction that involves inventory. It always has those two parts. Recognize the sale, and then we recognize the cost of the inventory that we sold. So here is a nice example of that. The corner store sold $1,000 worth of inventory on credit, meaning accounts receivable. The inventory cost the corner store $300. Okay, nice. That's a nice profit margin, I would have to say. So we recognize the sale. Debit account receivable, $1,000. Credit sales, $1,000. Second part of that transaction, we debit cost of goods sold, $300, and credit inventory, $300. Yeah. Once again, every single transaction that involves inventory, these two parts of the transaction must be there. All right. Now, I love myself a good discount. You know that already about me. I like discounts. Both the retailer likes their discounts when they are paying their bill. If they pay it early, they get a discount. Who doesn't love that? Also, the buyer likes getting a discount too, right? If I'm buying inventory from my distributor, I like getting a discount. So I'm going to pay them a little earlier to get that discount, right? So credit terms can also be involved on the buyer side as well, or the customer side, I should say. So you sell something to your customer, you give your customer credit terms. The customer is going to pay you a little less cash if they take the discount, and then the full amount if they don't. But the reason why you might want to offer your customer credit terms is to encourage them to pay you early. Yeah. But it works the same exact way as it does with on the other side. So here's an example of this. A corner store sold $1,000 sale to a customer with credit terms, 2% discount if paid within the first 10 days. Otherwise, the whole thing's due within 45 days. That's very generous. Okay. So we've already recorded the sale, as you know, on November 12th. Now our customer is going to pay us. If the customer decides to take the discount, we're going to receive $980 in cash. So customer takes the 2% discount. 2% discount is $20. Okay. So customer gives us $980. The sale was for $1,000. They gave us $980 because they took the discount, 2% discount. The difference is $20. So we debit cash $980. We debit an account called sales discounts. Okay. $20. Now we credit accounts receivable, $1,000. See how it all balances. Your debits always equal your credits. If the customer decided not to take the discount, it's real simple. They're going to pay us $1,000, and we're going to reduce their account receivable for $1,000. Now, the thing I don't like about business is right here. Sometimes the customer ain't happy with us. Why? Because
Dr.
maybe we
B,
sold them something that don't work.
Dr. B,
Yes, please.
I'm sorry. Why wouldn't a customer take a discount?
Why wouldn't they?
Mm-hmm.
Maybe they don't have enough cash at the time.
Okay.
Yeah, that's usually that's really typically the only reason. Or they forget. That's the other big reason why they wouldn't. Either they don't have enough cash or they forgot about it. Yeah, it happens. Yeah. So here's the thing I don't like about business. Sometimes the customer receives broken stuff and they're not going to be happy with us. Okay, so they're going to want either to return the inventory. Ooh, always hurts. Or we're going to give them an allowance, a discount on their account receivable. Both are very possible. So, but the reason why I don't like this is because I don't like having upset customers. It usually results in bad reviews. And also, I don't like giving money back. So, yeah. So that's why returns and allowances for the business, not always great. So let's say that customer, that one that we sold $1,000 worth of stuff to back on November 12th. Well, that customer came back to us and was like, hey, you know what? Some of the stuff you sold me was defective, so I'm going to send it back. Ugh. So simple. I debit sales returns and allowances. This is a contra revenue account, holds a negative balance. So debit sales returns and allowances, credit cash, because I got to give them a refund. That's if we sold it and yeah, it was not good. Here's another example. Let's say we sold the inventory. Oh, I'm sorry. We sold that. So the customer gave us a return $15 worth of inventory that inventory that they gave returned to us. If it's not defective, meaning we can resell it, we're going to put it back in our inventory so we can sell it again. If that's the case, I can sell it again. I'm going to debit inventory to increase the inventory, in this case by $9, because that's how much the inventory cost that we sold. And I'm going to credit cost of goods sold to reduce the cost of goods sold. This helps us to put the inventory back in if we can resell it. If we cannot resell it, that entry doesn't occur. It's just the return. Then we have to just write that part off as a loss. So let's assume $40 of the inventory that we sold on November 12th is defective, but the buyer decided, hey, you know what? I'm not going to go through the pain in the butt to return it. So we made a deal with the customer, said, just keep it. We'll just give you a price reduction on what you owe us, or if they don't owe us anything, we'll just pay them $10. So a debit sales returns allowances $10, credit cash $10. It happens. Now, just like we've done, with other businesses, we also have to go through our adjusting entries at the end of each month or end of each year. And we also have to close out our temporary accounts. This completes the accounting cycle, just like we talked about, I'm pretty sure it was last week. So here we go. So at the end of each year, I need to kind of reconcile my accounts. So the way that I do that is the first thing I do is figure out how much I purchased throughout the year, plus the beginning inventory. That equals merchandise available for sale. If I sell the inventory throughout the year, it becomes cost of goods sold, shows up on my income statement. If I don't sell the inventory by the end of the year, whatever's left on my inventory is on my balance sheet as what we call ending inventory. And that's just displayed on the balance sheet as the inventory amount at the end of the year. Whatever you end the year with inventory is going to be the beginning amount for the next year. Makes sense, right? Because you still have it. You still plan on selling it in the following year. So it becomes your beginning balance for the next year. Then you go through the same process again. Sometimes things happen in business, especially for retailers. Uh, you know, inventory fell off the shelf. It got damaged. Maybe it was stolen. It's retail. Retail things happen to our inventory all the time. We lose it, right? Oh man, don't give me Sears. Let me tell you about Sears. So Sears, as some of you may recall, big box retailer, sold pretty much all stuff. Yeah. So uh, one time I watched the back room. In the stock room. In the stock room, they have a big cage with the TV sets, television sets, and uh, they would count. They every year they would do the inventory. They would audit the inventory by doing physical counts. Some numbskull, uh, doesn't know how to count, and so they missed a few televisions. All right. So what they classified it as what we call shrinkage, which is the loss of inventory. Okay. This happens from time to time, but it has a negative effect on the income statement. Yeah. Because we have to, of course, reduce the inventory and increase the cost of goods sold. Right? Why increase cost of goods sold? Because it no longer have the inventory. At least so we think. So I have to count it as cost of goods sold. Now, as you know, if I increase cost of goods sold, what's it do to my net income? It reduces it because I have higher expenses, right? So I debit cost of goods sold, credit inventory for the loss of any inventory. This is why it's important that in retail, you want to audit your inventory. So you want to do a physical count, even if you use perpetual inventory, which is great, you still should do a physical count just to make sure whatever's in your system is actually what you have on the shelves. So that's why sometimes you might go to a store, you're going to see the little tags on everything. They're doing inventory. They're checking what they actually have and comparing that to what's in their system. Yeah. It's always a good idea to do that. So at the end of the year, all right, I should say at the end of each month, we have to close out our temporary accounts. Now, as you remember, temporary accounts are all the accounts on the income statement, all of your sales, all of your expenses. We close those out to our income summary, which gets closed out to our retained earnings. So the way it works is we're going to debit our sales, credit income summary, debit income summary, and credit all of our expenses. And what that does is it closes out all of your temporary accounts to income summary. We close that out to retained earnings, step 3, and then minus any withdrawals that the owner takes out. Very simple process to close out temporary accounts. We do that for every single business at the end of every single month. And the great news is with modern technology like QuickBooks or any type of other accounting software, it's very easy. Very, very easy. Matter of clicking a few buttons. Okay, and then this slide and the next slide are really just some summaries, just to kind of show you the type of entries we make and why. So for purchases and sales, and it shows you the respective transactions. I like this slide a lot. Hint, hint, this might help you for maybe a quiz. Just saying. Keep things easy for you. I also like this one. Once again, this would be helpful for a quiz, for adjusting entries, closing entries, that type of stuff. All right. Now, as you know, there's a couple of differences between service businesses and retailers. I'm going to show you and I've already showed you really the difference on the income statement. For a service business, we just simply have our sales minus all of our expenses equals net income. Very simple. We call that a single step income statement. Sales minus expenses equals net income. That's a single step. See, very cohesive. For a multi-step income statement, it has multiple steps. We have sales minus cost of goods sold equals gross profit. That's one step. Minus all of your operating expenses equals operating income. Then minus your other stuff like interest and taxes equals net income. You can see why we call it multi-step, because there's multiple steps. We compare that to the service business or single step format. Sales minus expenses equals net income. Boom. Easy peasy. I prefer the multi-step. Why? Because it shows you as a manager a lot more detail. That's why I like the multi-step. It helps you to analyze things easier. On the balance sheet, especially for a retailer, the primary difference between a retailer and service company on the balance sheet is inventory. Service businesses don't have inventory. Retailers do. So on the retailer's balance sheet, you're going to see an account called inventory. That's what this shows us. Every single balance sheet is organized by the order of liquidity. And just like we talked about a few weeks ago, liquidity is how quickly I can convert something into cash. And as you can see, all of my current assets, cash on the top, account receivable, inventory, office supplies, other supplies, prepaid insurance, it's ordered in the order of liquidity, how quickly I can convert those things into cash. Inventory is not that easy to liquidate, right? As we've seen from large retailers that went out of business.
I'm sorry, keep muting. Hello, can you hear me?
Yeah, I can hear you now. Yep.
Okay. Hey, how's it going?
Good. How are you?
Oh no,
It's all right.
I'm sorry, my job was calling me. I apologize.
You're good. It's all right. Well, I mean, we could join in on the conversation, but it's all good. All right. And then one of the last things, for at least for this chapter, that I need to talk about is called the acid test ratio. The acid test ratio, what this does is it helps us to identify or measure our liquidity. Right? That's really the essence of an acid test ratio. Now you're going to notice something with this ratio. We take our quick assets, what we can quickly convert into cash, and it's divided by our current liabilities. Now look at this part. Cash plus short-term investments plus receivables. Those are my quick assets. The reason why we don't include things like inventory is because it takes a longer time to to convert your inventory into cash. So that's why we don't include inventory in the acid test ratio. So, of course, with the acid test ratio, we want this to be above 1. Anything above 1 we consider to be okay. Anything above 1.2 is doing pretty good. For our current ratio, which is our current assets divided by current liabilities, we want that to be anything above 1 is considered good. And another ratio to quickly tell you about is called the gross margin ratio. I love myself a gross margin ratio because it tells me the percentage of sales dollars that we have to cover expenses in order to provide the company with a profit. And the way we calculate that is we take net income, or I'm sorry, net sales, source, net revenue minus cost of goods sold. And then we divide that by net sales. The other way to think about this is we take profit margin divided by sales. Profit margin divided by sales gives us gross margin ratio. Okay. And then just the appendix just kind of shows you the differences between the periodic and perpetual inventory systems. Really, the primary differences between the two are just some of the names of the accounts. That's really it. I mean, that's really it. That's the only difference between the two. And it's just the way that we treat the inventory. Periodic, we recognize our purchases and our sales at the end of each month, whereas perpetually, we recognize our sales and purchases as we go through the month. Yeah. So it just kind of gives you a nice side-by-side comparison between the two. And then sometimes we need to make adjusting entries for discounts. This is just an example of that. If this is for future discounts. I wouldn't worry too much about that. We're not going to go deep into that. We're going to skip over this next few because they're not really relevant. And then just once again, comparison between gross method and net method with how we treat discounts and allowances. Okay, so that is our chapter on how we account for retail businesses. Do any of you need a break, or are we doing okay?
Can we get like a 5-minute break?
5-minute break. I'm down for a 5-minute break. Okay, so let's do that. Let's take a 5-minute break. Let's be back here. Let's say 7:05. Okay, so 7:05, 7:05, which is I guess 6 minutes. Yeah, 6-minute break. Let's be back here 7:05, and then we will jump into the next chapter, which is on how we value our inventory, which is another great conversation. So let's be back here 7:05. See you soon.